because the bond market is saying, look, we're headed maybe for recession here, and the stock market's saying, party on. And you have to reconcile these two things. Now, one of the things that's helped the stock market is the bond market rally. Yields have gone down. That makes the yield on the S&P 500 really a great bargain relative to the 10-year Treasury yield. On the other hand, Wall Street has already gotten everything it could have wished for the year. When you look at what Goldman Sachs, Morgan Stanley, UBS was projecting for year-end returns, we're already there or higher. And so you look at what are they going to project from here? It's eking out gains from here, maybe another 5%. That means the risks are more symmetrical. Because you certainly could have a 5 or 10% pullback at any time. And I think that means the market is going to be more news-driven and more selective. These stocks are doing well versus those stocks.
I don't know. If the bond yield was really flashing recession, don't you think that would be a headwind for stocks? I mean, couldn't you also make the case that the lower bond yields, which has been a global phenomenon, just has to do with the fact that central banks are back in the game?
Yeah,
and they're starting a new easing cycle here.
It's more booze in the punch bowl. The question is, when do you get diminishing returns? And we've seen the stock market respond very positively to the idea that the Fed is going to cut rates maybe half a point next month. If they don't cut rates, that could set the stage for a little bit of a disappointment. If they do cut rates, then what's the message we're getting from the Federal Reserve Board and the bond market all at the same time? Don't forget, we saw those PMI numbers start to slip. That's a leading economic indicator, and we are seeing some signs of a real slowdown, not necessarily recession enough yet. We're not seeing it in the home builders and the semiconductors or emerging markets, but we are seeing some signs.
Julia, what's top of your list for what you're watching for the second half of the year?
Well, yes, I think it's important to keep in mind the market is reacting to this central bank easing around the world. And there's a reason central banks are easing, and that is because the global economy has slowed pretty sharply. The PMIs are the primary place we see this. The global manufacturing cycle is in a recession as of May, and no signs that it's stabilizing. So I think the risks to this sort of glass half full and getting fuller is to the downside. In particular, I look towards October when companies start guiding about 2020. Are they going to be able to deliver double-digit earnings growth amid a global slowdown and a trade war? So I think more than likely we'll see guidance towards a more moderate outcome like we saw this year. That was the catalyst towards last October's sell-off. So I think it's, given the euphoria that's priced in right now, I think the bond market is seeing the reasons why the Fed is back in the game, and that is that the global economy doesn't look so great.
So, Julia, if you're looking at manufacturing in this country, yes, things have slowed down. What about the consumer? I mean, more mixed reads. Today, consumer confidence was okay. I mean, incomes and spendings were okay. It wasn't recessionary numbers.
No. The consumer so far, the U.S. economy is benefiting from a virtuous cycle between the domestic service sector and the consumer, because the domestic service sector is 80% of jobs. So as long as that holds and there isn't spillover from the manufacturing recession into the service sector, then I think the U.S. economy can, manage that soft landing. But I think that the Fed is doing risk management right now, and they're going to deliver at least 1 or 2 rate cuts to make sure that happens. That said, for stocks, the earnings growth necessarily will be slower if growth is slower. And overall, even if we stay on track, I think the top line is going to slow.
David, provided the U.S. trade war doesn't escalate over the course of this weekend, can U.S. corporates shrug that off throughout the second half of the year?
I don't really think that they can. We've just recently, on June 17th, reduced our equity weightings for Citi Private Bank clients globally, and the reasons are a lot of the ones that Julia just spoke about. We're very concerned about the ability for companies to continue to grow earnings and revenue in the environment that we're talking about. Mexico growing at 1%, Brazil at 1%, Europe at 1%, with parts of the German economy in recession and a slowing in manufacturing in the United States. So there are quite a few headwinds, and the Fed's action doesn't necessarily mitigate all of that. One of the big concerns that we've got right now is that 5.5% of revenues of the S&P 500 in China in the U.S. Are exposed in China. And while we may just see a kick the can event at the G20, the fact is at some point what's happening in China will affect revenues, will affect earnings, and will be a further drag on the U.S. economy and on the S&P 500. So we see more headwinds than tailwinds at this point.